Hello and good evening, everyone, and thank you for tuning in Investing Bootcamp webinar with Sarwa. My name is Eamon Gebri, Head of Wealth Advisor here at Sarwa, and I'm joined alongside my colleague Akshay and Wealth Associate, and we are excited to be sitting with you today to be sharing best practices when it comes to investing. Now, I want to give it a few minutes for everybody to come into the room. I completely understand that this might be the dinner hour for some, or for some of the individuals joining us might be on their way home on the drive on Sheikh Zayed Road or so. So feel free not to worry. We'll give you a couple of minutes before we start. Maybe we should introduce ourselves, Akshay?
Yes, of course, let's do it. And thanks for the introduction, Eamon. My name is Akshay. As Eamon was saying, I am part of the advisory team. I am one of the wealth associates, and I actually have a background in banking as well as private wealth management. I started my career at the Canadian Imperial Bank of Commerce in Canada. It's also where I was educated, and following that, I worked for a British private wealth management company. So I've actually been with Sarwa for actually around 8 months now, and time is really flying. Really happy, about what we're doing here at Sarwa in terms of democratizing investing and bringing across, very flexible, transparent, and low cost platform to this region. But yeah, thanks a lot. I'm really excited to be presenting this webinar as well.
Spectacular. And it's been a wonderful joy having you with us as well, Akshay. I've been here, approaching 18 months now with Sarwa. I've been in the region now for just over 11 years. I spent much of that time with HSBC in the retail banking wealth management division, assisting clients with their financial goals. Spent a further, 10 years, I think we're just rounding it up, around 10 years with a bank called TD Canada Trust in my hometown of Toronto, Ontario. And we're both fellow Canadians, just in case if anybody's curious on the accents themselves. We don't believe we have accents, but that's a different story. It's debatable altogether.
Yeah.
I think we've got a pretty full house right now. We've got a number of participants in there. Shall we start, Akshay?
We do, yes, let's do it.
And for those who've just come in, this is the Investing Bootcamp webinar hosted by Sarwa. Again, my name is Eamon and this is Akshay, and we're going to be talking about best practices that each and every one of us can take in order to help us with our financial goals. Now, I always like to start it off, and it's very key and very important, especially for those who are first-time attendees of our webinars. It's important to highlight that the conversations and the views that we're taking today should not be interpreted as one-on-one financial advice. This is a forum in which we're going to be talking about best practices, but if you are looking or seeking any guidance about your individual circumstances and which direction to take, just give us a call. Come on in, book an appointment with us. We're available by phone, we're available by video. We're more than happy to assist. We've got a wealth of information and material that can give you guidance on best practices on our YouTube, Instagram, LinkedIn, etc. But best practice in this case to get individual advice is just have a conversation with us. And secondly, we don't have a crystal ball. As much as I would like to have a crystal ball, as much as I would like to share with you what's going to happen in the markets tonight, unfortunately, I don't. Neither Akshay and I do, nor do any investment gurus that might be calling themselves that on Wall Street. Nobody has the ability to predict the future. It's just a matter of making the right decisions to help you achieve your financial goals. So without further ado, let's jump into who is Sarwa. Let's give you a quick overview about who we are. We were the region's first digital financial services company. And that doesn't necessarily mean, we were the first investment company or whatnot. There's plenty of banks that have been operating in the region for many years, but we were the first digital first platform where you are able to invest for your long-term needs using any one of our services. And the entire journey end to end is digitized so that for your convenience, it makes life a lot easier for you and easier for you to start. Now, we offer three key services here at Sarwa. We've got Sarwa Invest, we have Sarwa Trade, and we have Sarwa Crypto. And we'll dive into that in a little bit as far as what each of those verticals do. Now, our aim is very simple. It's to democratize investing by offering cost-effective, transparent, and easy-to-use investment solutions for all investors. And we are regulated. We're regulated by two of the strongest regulators within the region, by the DFSA, which is within the DIFC and where I'm sitting at the moment, and by the FSRA, which is Abu Dhabi Global Markets. And we also have a list of partners who are shareholders and supporters of Sarwa, which include Mubadala, the DIFC themselves, and Shuruk. That's a little bit about us. Now let's jump right into the conversation today, which is about following the best practices. Now, when we first started Sarwa, we had an idea of what the challenges that most individuals were facing within this region when it came to investing for their long-term needs. But we needed to do some research to validate it. And what we discovered was that many of us, and not necessarily specific to this region, but as international individuals we've seen this in other markets around the world, that we don't tend to have the greatest of money management habits. It's not something, unfortunately, that was taught to us in primary school or in high school. Some of us may come from finance majors or whether it be accounting, but personal financial planning is not necessarily a common topic that's taught in schools. And as a result, many of us don't know where to start or how to start. And we tend to procrastinate, rather than starting and working towards our goals. And when we end up researching solutions that are available in the market, we tend to find that, that experience to be very fragmented and very challenging. We end up finding solutions that are either too expensive, sometimes a little bit difficult to understand and complicated, and at times very restrictive. The culmination of all of these challenges and these barriers to entry basically causes us to not have enough savings for our goals that are very common to many individuals here who come into the country with aspirations of saving enough money for their long-term goals, such as retirement or saving money for their children's education, give you that dream home that you had, or financial independence, just as a general goal. It tends to be very challenging if we procrastinate and don't start working towards it. And 61% of the people surveyed in the UAE do identify with this because they don't have any long-term savings at all. So how do you overcome this? How do you resolve this problem? Well, this is what we're here to talk about today. And as a best practice number one, and if we like to say rule number one, is start now, yesterday, if possible. The famous finance author Robert Allen stated, "How many millionaires do you know who've become wealthy by investing in savings accounts?" I rest my case. Now, this quote wasn't meant to be tongue-in-cheek. It was actually meant to identify the perils of just leaving money sitting idle in cash in your savings account. Because unfortunately, leaving money in a savings account isn't exactly working to its best possible opportunity to be able to develop growth for you. And let's highlight why that is, right? Let's talk about inflation. One of the key, most significant impacts to our net worth, to our ability to afford the day-to-day things that we need, whether it be goods and services. And typically inflation ranges between 2 to 3% per year. Although I know it's a very hot topic right now where it doesn't really feel like it's between 2 and 3%, because it's not. In the US, for example, they've just reported that their inflation rates are at 8.6%. And UAE, although thankfully not as high, definitely sometimes feels just as high when we go to the gas pump. Well, suppose that you had $1,000 today at a rate of 2.5% inflation rate. I'm being on a conservative end here. $1,000 today, what is the purchasing power of this $1,000 10 years from now, with the assumption that life gets more expensive to the tune of 2.5% per year? Unfortunately, your $1,000 will only give you the opportunity to have a $720 purchasing power at that point in time. So the power of your purchasing power is basically diminishing over time. Now, sometimes it's a little bit abstract to think about it. It's like, okay, so I have $1,000 today, but it's going to be $720 later. I mean, how does that work out? What's the bigger picture? Well, let's take, for example, things that many of us aspire to achieve at certain points in our lives. Let's talk about purchasing a home. And let's say we use the figure of $650,000 as a typical 3-bedroom home here, within the UAE. Let's just say a villa of, or a townhouse, let's just say. Property prices rise over time. And on average, they tend to range anywhere between 3 to maybe 4% at times, 5%. But in this example, I've used 3%. So if you're considering purchasing a property today that's worth $650,000, but you waited and you decided to wait, and 10 years go by, well, that same house would likely go for a price of $873,546. Let's talk about university education. This figure that you see before you is for a 4-year program in an undergrad university in the US, which is the biggest magnet, by the way, when it comes to international students. That tends to be the most popular destination that parents tend to send their children. For a 4-year program, room and board, tuition, little bit of stipend for your child to make sure they're not just eating macaroni and cheese every single day. It'll roughly cost you around $150,000. Well, assume that there's a inflation applied on university fees of just 3%. In 15 years' time, you'll have to pay $223,695 just for a 4-year program. Okay, and keep in mind, I'm using 3% here, but typically university inflation rates are typically higher. They range anywhere closer up to between 4% and 5% per year. Cost of living. Let's assume today that you are able to get by and pay all of your bills, have a little bit of leftover money for entertainment, and that's going to run you about $5,000 a month. Well, if you wanted to live that same lifestyle 20 years from now, you'll need at least $9,030.65 a month just to be able to keep up with the cost of living increases over time. The point is, leaving money in a savings account will not help you achieve these goals, will not help you keep up with inflation. It's not working as hard as possible for you. So you've got to take a decision. And that decision is to make your money work as hard as possible for you by investing it. Now, investing is a very general term. And Akshay and I talk about this all the time, where there's different avenues that you can consider. Some would talk about real estate. Some may decide to invest in land. Some may decide to start a business. For the focus of our conversation today, we work with capital markets. We work with the stock markets themselves. And what you should be aspiring for to make your money work as hard as possible for you is that you should find an asset that's either going to generate an income or appreciate in value for you in the future, which is going to combat and beat the effects of inflation. Ideally, you want both. And there's no greater solution that we believe in than investing in the stock market. Investing in the stock market gives you the opportunity for capital appreciation, which basically means that you're purchasing a stock today with the hope that it's going to appreciate in value in the future. In addition to that, and this is one of the beautiful things about holding a stock portfolio, is that you receive dividends. And dividends are very simply payments that can either be made in cash, and in some cases stocks as well, by publicly listed companies to reward investors for putting their money into their venture. So if you decide to invest in, let's just say Pfizer, for example, you have the opportunity to make money by investing in Pfizer through the capital appreciation of the stock and also the dividends that they pay out to the shareholders. You combine these two, and this is how you grow your wealth over time. And this is how you make your money work as hard as possible for you. Now, it's not all sunshine and lollipops, and I may be simplifying it in this conversation, but there is risk involved when it comes to investing. And that at times could be a big, barriers to entry for some individuals where they're just not comfortable with risk. They like the idea of seeing their balance, very predictable, being able to see it day after day, stagnant at the same value every single day, because that gives them a sense of comfort. And I understand that. But unfortunately, volatility is inherent to investing. If you're looking for a reward, there must be some risk that you have to be willing to take. Because unfortunately, markets don't just go up on a linear fashion. They tend to be sometimes erratic and sometimes can be very unpredictable. And if any of you have been seeing your pop-ups, recently on any news, sites that you're subscribed to, we know that the market is a hot topic right now, and we know there's a lot of volatility happening. Well, that is something that's unfortunately indicative of just investing in the stock market. To give an example, 2008 was a very pivotal moment in the stock market. We saw the financial crisis, in which we saw portfolios, US stocks, for example, drop by about 50% within such a short period of time. Okay. In 2020, and that's very near to our memory, when we had the COVID lockdown, so the beginning of the COVID pandemic, where we saw the stock markets drop by about 35% within about a month, right? Very erratic. And for those, faint of heart, maybe a very uncomfortable experience to go through. But I challenge you to do one thing. Take a step back. Take a bird's eye view. Understand how markets have performed over 10 years, 20 years, 50 years, 100 years. You'll be quite surprised and astonished as to the power of investing. This chart before you, it basically tracks all the different asset classes that you could potentially invest in, okay? And it goes all the way back to 1925, okay? And they back tested that had you invested $1,000 back in 1925, where would you be today? What would the value of your portfolio be today? Well, If you had invested $1,000 and assumed that you left it in a savings account, and you hope that the savings account rate was at least equivalent to inflation, well, that $1,000 today would be worth $15,653. Like, okay, well, it's more money than 1,000. That's great. But look how many years we're looking at. We're looking at nearly 100 years here, and you've only accumulated a portfolio of $15,653. Now, suppose that you decided to invest in bonds. Bonds are a very safe asset class for the most part. And obviously, there's different shapes and sizes when it comes to it. A bond portfolio, had you invested in it back in 1925, a US bond portfolio would have given you a value of $118,103 over those many years. Very interesting. Not exactly the most spectacular, but nonetheless, very interesting. Take a look at the top of the chart. Had you invested in the US stock market, and let's take, in this example, would have been the S&P 500. Had you invested $1,000 and did nothing else in the following near 100 years, your $1,000 today would have been worth $12,342,456. The S&P 500 since 1925 has returned on average of 10.2% per year. And this is in spite of all the volatility that we'd have ever gone through. We had the Great Depression, that's included in the chart. We had the World War II, we had the Korean War, we had the Gulf War, we had the oil crisis in the 70s, we had the 2008 financial crisis. You name it, it's there. And yet, in spite of all this, the markets still continue to rise. And the one thing I wanted you to just take away from this slide itself is that time is the greatest equalizer when it comes to investing. If you have a long investment horizon and you're patient enough, you will be rewarded. And there's no greater chart that I love to look at than this, to be honest with you. I don't know if this is one of your faves, actually, but I love looking at this just because this gives me confidence that anytime there's any volatility, that I'm not worried because I have long-term outlook in investments.
Yeah, me too. I mean, look, we're actually almost 100 years from that point, from 1925. So the way that I'm thinking about it is, look, what are we going to see in the next 100 years? And if it's going to be anything like what we've experienced over the past 100 years, look, we're all going to be in an amazing position. So I'm very optimistic about this.
Absolutely, absolutely. And look, let's summarize it here. What's the best way to start? I like to kind of use visuals here just to kind of help you etch it into your mind. I always think the best way to start is by identifying a goal, whatever it might be, whether it be financial independence, or whether it be saving for your children's education, purchasing a home, retirement, whatever it might be, whatever's personal and deep and important to you, start with that. Understand your why. Rather than the what, understand your why do you want to invest. And I think this is really key. The second step that's ideal to take to prepare yourself to invest is manage your debt. Unfortunately, we are operating in a region where the average credit card interest rate is anywhere between 30 and 36% per annum. So if you're finding yourself in a situation where you've got balances carrying forward month after month, that's 36% in interest that you're paying. You'd be hard pressed to find an investment instrument that's going to give you 36% guaranteed year after year. So it would be to your best advantage. It would be to your advantage to be able to actually try to eliminate your debt as quickly as possible before you start thinking about investing. The third step to take would be to build up your emergency reserves. And what I mean by that is, in the event there's any interruption to your income source, or whether there's any emergencies that require financial output, it's best to allocate at least 3 to 6 months worth of emergency reserves sitting idle in the savings account. As much as I spent a few minutes talking about the importance of putting your money to work, having 3 to 6 months worth of emergency reserve, when I say 3 to 6 months, 3 to 6 months worth of fixed expenses, if you set that aside, the value of having that there is greater than the opportunity cost in itself. Because when a situation occurs where you do need money and access to it rather quickly, there's no greater place or no greater feeling than having that accessible to you that you can dip into, rather than having to dip into your portfolio. Now, if you find that you've set a goal, you have no debt at this point in time, or it's under control, you have your emergency reserves, and you still find that you have excess liquidity beyond the 6 months, consider using this or utilizing this as a lump sum to start your investment journey. So for example, if your emergency reserve requirements are, let's just say $20,000, but you so happen to have $50,000 in total savings, that additional $30,000, consider that as idle money, unproductive money sitting around. Utilize this to start investing as a lump sum contribution. Then what you do to finalize this and finish off your journey is contribute regularly. Supplement your investment path, investment journey, right? Every single month, if you're getting paid on a monthly basis, let's say it's the 27th of every single month, slice off a piece of that pie and allocate it towards your long-term goals. Slowly, you're steadily building up your reserves, building up your net worth so that when you get to that milestone where you have enough to be able to buy the house or have enough to retire, whatever it might be, you're going to be super happy and excited that you've done that all together. And that's how you start. Now, that's rule number one, best practice. And I do hope everyone has been taking notes. If not, not to worry. This is recorded and we will be sending it out to you, so you can always go back and review it. The second best practice or rule is to diversify. So we've got the rule number one, which is start now, start immediately, start yesterday if you can. And rule number two is diversify, meaning what are you going to be investing in? John Bogle, which is the father of Vanguard, one of the largest asset managers in the world and who specializes in ETFs, had a very famous phrase. He said, "Don't look for the needle in the haystack, just buy the haystack." Now, what did John Bogle mean by that? Well, if you were attempting to pick and choose what to invest in, based either on your own research or maybe something your cousins may have told you, or your family members, or your friends, colleagues, etc., whatever it might be, or maybe an individual on, online on Twitter, you'll be quite surprised to see that asset classes don't really follow your methodology. They tend to perform in a myriad of different ways. And to kind of highlight how they perform, on the chart on the very left-hand side, it'll show you the different asset classes that most investors would typically invest in. And it highlights what the returns have been from 2017 until 2021. On the top left-hand corner, you'll see the acronym. It says EM. EM stands for emerging markets. So had you invested and concentrated all of your investments and identified stocks within the emerging market region, you would have had potentially a portfolio return of 37.8%. You'd be pretty happy with that. I know I'd be happy. Would you be happy with that, actually? 37%
100%,
return?
yeah.
It's a great win. In 1 year, that's spectacular.
Yeah.
Let's suppose in 2018 that you wanted to duplicate that result. And you wanted to invest in emerging markets again because, hey, I did really well in 2017. Surely 2018 shouldn't be that different. Well, interestingly enough, in 2018, emerging markets had a return of negative 14.3%. Sorry, were you going to say something, actually? Cut you off.
No, I was just answering a question. I find that what you've just said is amazing because look, in 2017, it was at the top of the chart. 2018, it's the complete bottom. So that just really emphasizes how random returns can be.
Absolutely, right? Now, suppose that you wanted to change things up, okay? Maybe because you saw in 2018 that cash was king and it did really well. So you're going to invest in cash in 2019 because there must be some rhyme or reason to it. Well, in 2019, cash was at the bottom of the pile. Although it had a positive return, you had a return of 2.2%. Whereas had you invested in large cap stocks, you would have had a portfolio of 31.5%. Do you see the randomness of returns? Do you see that you cannot just choose one asset class or one sector or one geographic region and repeat that exercise to get the same performance on an ongoing basis? It is going to be erratic. Now, even if you took it a step further, maybe you wanted to just focus on the entirety of a particular market. Maybe you wanted to focus on a country, never mind one particular asset class, but let's just say I want to focus all of my assets in the US, only US companies altogether, or maybe I want to pick Hong Kong, whatever it might be. Well, the chart on the right basically highlights the international stock market returns. Who would have known that in 2019, New Zealand would have been the best performing market globally? Who? I mean, any Wall Street guru or any investment advisor would have never picked that New Zealand would have been the best performing asset class. But guess what? In 2020, it was Denmark, right? This is the randomness of returns. And in order for you to find a best strategy to invest, it's ideal to diversify. And one of the greatest tools that you can use to diversify, we can thank John Bogle for this, for popularizing it, are ETFs, or exchange traded funds. Very simply, an ETF allows you to buy your stocks, to buy your bonds, buy your real estate, buy many different asset classes, all through one product, okay? One security, one stock in itself will allow you to diversify amongst the technology sector, healthcare industry, consumer discretionary, IT, energy, communications, you name it, you'll have exposure to it through an ETF. This will allow you to diversify your portfolio in one of the most simplified manner because all the work has already been done for you. You could even diversify on a geographical basis. If you wanted to find an ETF that has exposure to Japan, United Kingdom, Switzerland, France, etc., this is all available through, for example, in this example would be the developed market ETF provided by iShares by BlackRock. This ETF will give you exposure not only to different industries, but also different geographic regions as well too. And that's why an ETF is one of the best tools to help you diversify your portfolio. And this is what we do, apply here at Sarwa, by the way. If you haven't seen it yet, if you haven't taken a look at our portfolios, we have a conventional portfolios, a socially responsible portfolio, we have halal portfolios, and each and every one of them applies diversification. We use ETFs to give you access to US markets, emerging markets, developed markets. If you're in our halal portfolio, you'll have access to gold securities. You also have access to sukuks. If you're in our conventional or our socially responsible portfolios, you'll have access to fixed income, real estate investment trust or REITs. You can even diversify further into cryptocurrencies if you like, because you have access to, you have the ability to access a Bitcoin fund through our portfolios. So that is, a great way to diversify. Now, for those individuals who, who prefer to, let's just say in this case, they like the idea of diversification, but they also want to maybe double down on certain industries, right? Maybe you already have exposure to, let's just say, Amazon, but the ETF itself will only give you a limited exposure to Amazon. Maybe you had a little bit extra money that you wanted to double down. You're really passionate. You really enjoy the company's products or services, and you feel that on the long term that this company would be ideal for you. There is a way that you can apply this approach through something called core and satellite. What I mean by this is that typically investing on an individual stock by itself tends to increase your overall risk profile because you're concentrating all of your assets into one particular stock. But what you can do is you can do a bit of both. You can apply a core strategy in which you have a passively managed portfolio through the use of ETFs, and you could also have a satellite component to your portfolio, which is basically adding any actively managed investments. And to kind of give you a quick visual of it, think of if you had $10,000, $8,000 of that, or 80%, is basically invested in a passively managed portfolio for you, which is all ETFs, and 20% would basically be your satellite, which is maybe you're doubling down on your Amazon, your Microsoft, or ARC Innovation, whatever it might be. It could even be a cryptocurrency, for example. So at least that way, you're managing your risk. You're not investing 100% of your assets into undiversified portfolios. You're actually just allocating a smaller portion, which is 20%, which is a really great way to kind of manage your overall risk. Now, we, of course, provide this here at Sarwa. So we have Sarwa Invest, which is our core approach. It allows you to invest in a portfolio which is going to be managed for you. We'll take care of the rebalancing. We'll take care of the reinvesting, the dividends. You have access to qualified advisors at any point in time that you can speak with if you have any questions or any concerns. Or you can, you can use Sarwa Trade, which is basically if you want to be behind the driver's seat and allocate that satellite portion of your portfolio, you can buy stocks, you can buy cryptocurrencies, you receive favorable FX rates. There's no transfer fees, between UAE banks. So there's a number of different ways that you can approach this here at Sarwa. And on that note, I think I've spoken enough. Actually, I think my voice is getting hoarse in time. I'll pass it over to you, in which we're going to talk about ways to lower your costs.
Perfect. Thank you very much for introducing those first two rules, Eamon. And also for everyone, just a heads up, also, we're going to be answering some questions at the end of the webinar. So if you have any, please feel free to throw them in on the chat function or the Q&A function, and we'll get to those at the end. But yeah, and look, rule number 3, obviously we covered number 1, starting now. We covered number 2, diversifying. Number 3 is all about lowering your costs. So if you basically look over here, An interesting fact that I think a lot of UAE residents should know is that the average UAE investor actually pays more than 3% per year in fees. And this is actually more than any developed country in the world. It's kind of crazy when you think about it like that. And fees is something that we're super passionate about at Sarwa because it's one of the few things that you can actually control when you're investing. So, let's use an example. If you invest in the capital markets, if you're just buying, into stocks or funds or, whatever it might be, the only thing that you can't control is the returns. There's so many large powers at force impacting markets, whether they're political or economic or social. And that's why it's really important to control what you can, which is your costs. Really, the higher your fees are going to be, the larger impact that this always has on your returns. And what you'll always find is that different types of investments have different fees that are associated with them. It's really important to get to know exactly what you're paying because transparency and simplicity is actually the most important thing when it comes to fees. When you basically look for an investment provider, they should be able to clearly illustrate your fees. And if there's any ambiguity, if you're not sure about this expense here or that expense there, it's honestly it's a kind of a sign to steer clear. Like the transparency of investment fees is actually a really big problem in this region. And normally when you meet with a traditional financial advisor, from first appearances, everything seems super cheap, super clear, everything, all makes sense. A lot of these firms, they advertise free fees or absolutely bare minimums. But when you actually look under the bonnet, there's all sorts of other fees that are often written in the small print, such as what you can see on the right, expense ratios and trading costs and commissions and all sorts of other things. And what happens is a lot of these financial salespeople, they're actually incentivized by commissions. And their main goal is to sell a product, gain a commission, and then move on to the next person. Unfortunately, a lot of people in the UAE have actually been burnt in the past by this way. And that's why it's really important to actually work with a fee-based firm whose interests align with yours as a client. So if we look at this slide over here, this is actually really interesting. So it's actually a hypothetical scenario that paints a picture on the importance of investment costs. Investment costs might not actually seem like a huge deal, whether that's 1% or 2% or 1.5% or whatever it might be, but that actually ends up adding up. It compounds along with your investment returns. So you're not actually just losing, that tiny amount of fees that you pay, but you're also losing out on the growth that your money might have had in all of those years to come. So if you look at this bar on the left, let's say you as an investor, Eamon, let's see, okay, you decided to invest $10,000. And every year when you invest that $10,000, 7% a year for the next 30 years, that money just compounded over time. You had no fees, no costs, anything like that. In that scenario, you actually would have ended up with $76,000 in earnings. And this assumes, no future contributions or nothing like that. But this is a perfect world scenario. And unfortunately, it doesn't actually exist, as you always do need to pay something. So let's use another example, Eamon. You decided, okay, that wasn't a realistic option. So instead, you're going to go with a fee, with an advisory firm that, the fees around 1% as an example. And I'd say that's relatively realistic. If you invest that same $10,000 and the account earned, that same 7% for the next 30 years, you'd actually end up with 57,500. And that's actually a good benchmark and a pretty impressive gain as well. Look, you're always going to lose a little bit of money to fees, but really not that bad. I wanted to highlight a completely stark comparison. So let's say, Eamon, that didn't work out. You weren't able to find somebody with 1%. So you had to deal with an advisor and they were charging you 4.5%. And look, that seems extremely unreasonable. But actually in the UAE, that's very common. So if you invested that same $10,000 and you were paying 4.5%, after 30 years, you'd actually have only $21,000 and you will have paid $55,000 just in fees. So in this scenario, you're actually forfeiting over 50% of your profits to fees. So I don't know, how would you feel about that? Let's say that happened right at the end.
I will never talk to you again. That's exactly what's
Yeah,
going to happen here. And
that's what I mean. Look, if that's happening to you, Eamon, you should be asking that advisor to drive you to work, wash your car, pick your kids up from school. I can continue this list. I can keep going. But look, that's really what it is. Like, there's a huge comparison. It might not seem that different, but fees are extremely important.
the sad reality actually is that many of these fees, I know looking at this, and for anybody who's on the call today would say, well, I would never pay 4.5%, right? The problem is that the way it's hidden at times, right? It's built
Yeah.
in. It's a flat fee here. It's a percentage here, here, and it's structured in such a way and so convoluted in terms of conditions that I don't think anybody willingly, would enter into an investment plan that charges 4.5%. But I can tell you, hundreds, if not thousands, of people within this region have. And it's unfortunate. We speak to clients like this every single day, and we try to help them and find ways to resolve that problem, to get out of those investment plans with the least impact possible. But in some cases, it's unfortunately, it tends to be quite painful for some clients when they enter into these agreements. So it's important to ask the questions, really what we're trying to say. Ask the questions, obtain clarity, transparency.
Exactly, 100% true. And this slide actually goes into that really well. And I wanted to share, a simple fee comparison between Sarwa and a lot of the traditional investment solutions in the marketplace. So look, I've been fortunate enough, or not fortunate enough, depending on who you ask, to have had the opportunity to work in traditional banking and then also private wealth management. So I'm actually very familiar with these fees that are levied by both. And I can safely say, in comparison to these investment solutions, Sarwa and other robo-advisory platforms, we really provide flexibility, transparency, and overall, lower costs than everyone else out there. Honestly, in this day and age, you want to have your investments to be as flexible and accessible as a bank account. And that's why we don't penalize you for exiting or withdrawing or anything like that. And what Eamon was saying before when we were talking about the slide about, a lot of people paying 4.5%. Yeah, a lot of people don't actually know that they're paying 4.5%. And these are those hidden costs. Let's say with a traditional financial advisor, there's going to be things such as entry and exit costs. With Sarwa, there's nothing of the sorts. With a traditional financial advisor, there's commissions that the advisors are getting paid. And that actually is, as I was saying before, when we started talking about fees, they get paid a commission and then they kind of move on to the next person. So, there's no commissions on our advice at Sarwa. They have withdrawal penalties and exit penalties and surrender penalties and all that sort of stuff. We don't have any of that stuff over here. And last but not least, when we're looking at the products that they're purchasing, the actual investment solutions, a lot of those investment funds will pay these traditional financial advisors a kickback or like a commission for selling their fund. So they're not actually independent. They're selling you something because somebody else has paid them. And obviously we're a completely independent firm and are pretty firmly against stuff like that.
I think it's important to give context here actually, because it's not like they're the bad guys, quote unquote. That's not what it is. It's just what's happened is, as technology has improved over time, newer entrants to the market like Sarwa have been able to capitalize on, cutting edge technology to basically automate and digitize our day-to-day. And when you do that, you basically reduce your overhead costs. When you reduce your overhead costs, that means it becomes a competitive advantage and you can offer services at a much cheaper price than our competitors, which are the incumbents within this region and on a global level. So many of these banks, like, as I said, actually, and I have worked in banking for many years. This type of service didn't exist, 10 odd years ago, right? There was no such thing as a robo-advisory company at that point in time. It was just maybe in its infancy, if anything else. But nowadays, it's actually becoming almost the norm. And now you're seeing banks are doing their best to try to keep up with the new, challengers that are coming into the fintech space altogether. And we're actually seeing nowadays, over the last 2 years, I would say, actually, we're starting to see some existing banks starting to spin off certain divisions of the company towards, providing more digital, digitized services, because they realize this is the growth, this is the trend. The population today, especially post-COVID, wants things, available on, on their phones. They want to be able to look on their computers. They don't necessarily want to physically have to go into the bank just to sign a simple document. We're in 2022. Convenience is really important for individuals, and that's kind of where Sarwa shines, where the entire journey is digital from end to end. But we employ a hybrid model. You can speak to human beings. There aren't robots behind the scenes and pressing buttons and whatnot. And that's why it's been working so well.
Exactly, 100% true. So guys, just to summarize, everything about fees. So I want to leave you with 3 key takeaways. So number 1, look for transparency and make sure you understand exactly what you're paying for. Number 2, if you are paying for advice, ensure that you actually are receiving advice as well as service. And number 3, try to use 1% as a fee benchmark for your overall costs. Great. So moving on to the next and final rule, which is all about managing your expectations. And I think this is a really great section and really important, especially now, considering markets are quite volatile. So, when it comes to investing, it's really important to not let your emotions cloud your judgment. And, this quote over here by Peter Lynch, he's actually an individual who managed the Magellan Fund at Fidelity, and he's actually a huge proponent of value investing. And I think that speaks volumes of truth at this time. The quote is, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. This really re-emphasizes the importance of not trying to time the market and speculate on the market. And this slide over here is actually a perfect illustration of what most investors go through. So we as investors, me, Eamon, everyone, honestly, in the world, we all invest based on emotion. But unfortunately, fear and greed actually tend to be the biggest reason for people either buying or selling. And unfortunately, a lot of people tend to buy when markets are high and sell when markets are low. Obviously, in an ideal world, you want to be doing the opposite and buying low and selling high. Often, you hear in the media or from your friends or, from whatever Twitter or whatever it might be, that a certain stock is performing extremely well, whether that's Netflix or Tesla or Apple. And by the time we actually buy it, it's reached an all-time high. And you've actually entered the market at what's called the point of maximum financial risk. And you're tempted to keep on buying more. Ultimately, inevitably, what ends up happening is markets tend to fall and we start to question our decision. You enter a sense of denial, which turns into panic. And then in this panic, a lot of people actually end up selling their investments and realize a loss. But actually, this is a point of what's called maximum financial opportunity. And I'm going to use an example that we love at Sarwa. And so look, if you've been eyeing a pair of sunglasses or a bag in a store, and suddenly you go into that store and you see that it's on a discount, you're not going to wait around for the price of that to go back to normal. You're actually going to buy the item on a discount. So it's really important to try and think about your investments like that. But I'm mindful, it's a lot easier said than done, and our emotions can actually get the better of us. In reality, it's almost impossible to consistently predict the markets. And that's why it's really important to have a financial plan and just ride that investment wave. Don't worry about short-term volatility, because when we actually look at history, we can see the benefits of long-term investing. And this slide over here is actually a study that's by Morningstar called the Mind the Gap study. And it actually measures how investors' actual results stack up compared with total investment fund returns. So firstly, I'm going to distinguish, the bar on the left is investment returns, which represents a simple buy and hold strategy of a certain set of assets. The investor returns bar on the right, that actually represents investors, such as me or you, who are invested in the same assets as the bar on the left, but had the opportunity to buy and sell at different moments based on trying to time the market. So if you can see that little line over there as well, so that's the behavior gap. And the behavior gap is the difference between the investor returns and the investment returns. And that actually stems from poorly timed purchases and sales of the fund shares, which actually cost the investors nearly 1/6 of the return that they would have earned if they'd simply just bought and held, just like the investment returns on the left. This study is actually conducted on a yearly basis. And each year they find that investment returns actually always outperform investor returns. So because, ultimately trying to time and outperform the market on a consistent basis is actually impossible. Investors simply don't stay the course. They let their emotions take over. But on the other hand, if you tend to just leave your funds alone, stick to the investment plan, that's when you normally reap a reward. Mm-hmm. So I'm just kind of finishing this up. I wanted to talk to you about 3 reasons why people actually act on impulse when investing and what you can do about this. So the first one on the next slide is that people actually often fail to filter the basically important information. And that's why, as I said before, it's really important to silence the noise. There's always going to be external factors that are impacting markets, and these factors are honestly much larger than us. You as an investor, it's important to focus on why you started investing. Focus on your financial goals. Make sure that you have an investment strategy in place and try your best to stick with it. I know it might be hard, especially in periods of volatility, but always think about that goal in mind. And disregard, what's happening in the short term, because often by the time you need that money in the future, you're not even going to remember what was happening. So number 2, another reason why people fail is they invest with no clear plan. So this slide really highlights the importance of financial planning and simple steps that you can take with your personal finances to actually ensure that you don't need to be concerned about market volatility. So it's really important, when you invest to have a goal or objective in mind, because by establishing these things, you'll be able to understand your attitude to risk, your time horizon a lot better. And it's a lot easier to actually silence the noise, what I was talking about before, because you have your investment plan regardless of how the market's performing in the interim. And a good place to start is actually asking yourself these 5 questions that we've got on the slides. How much can you save? How much risk can you take? How much will you need? When will you need it? And how much do you, potentially intend to leave behind? And this is, as I said, these are a fantastic place for most people to start. But one step I would say to maybe even take it a bit further is, speak with an advisor such as Eamon or myself, and we can actually help you identify these goals, set you up with a financial plan on actually how to achieve them. I'm actually a really big believer that everyone should have a financial plan. And historically, financial planning services have actually been only accessible, to the ultra high net worth individuals or very rich people and individuals in general. But at Sarwa, we really believe in breaking down those barriers. We want to give you guidance on where you are right now, where you want to be in the future, and kind of show you exactly how you can get there. And our last one, number 3, is that they fail to see the bigger picture. So often when people invest, they're constantly focused on what is going on in the markets and how their portfolio has been performing in the short term. What a lot of people forget to do is to take a minute, zoom out, and see how the portfolio and the overall market has been performing in the long run. This goes back to the slide before, Eamon, that we were looking at, of global markets and the return. If we look at this, little squiggly line on the left, there's a lot of periods of up and down, but overall, the trajectory is up. And look, short-term volatility is part and parcel of investing. We're going to experience it. But when you zoom out, you see how markets have performed over the past 100 years, from that 1925 period, we see time and time again, they rebound, they perform extremely well over the long run. And I think, look, as long as, this continued human and technological ingenuity, I think we're going to continue to prosper, over the long run. That's why it's really important to stay invested and reap this long-term reward.
Every time I see this slide, actually, it reminds me of an escalator more than it does with stairs. And I kind of like to think of this as an analogy for the stock markets. You would like to be at the bottom of the escalator on the way up so that you can basically enjoy the ride over the long term, right? At the end of the day. I don't know. It just comes to mind whenever I think of this image every single time.
100%. That is honestly a great analogy, and it actually looks like an escalator. So yeah, 100%.
Very steep stairs. Or that.
Yeah. So guys, like in summary.
Yeah, go ahead.
Sorry. In summary of our last rule, number 1, take a breath, don't panic. Number 2, block out the noise. Number 3, invest with a clear plan. Number 4, stop checking your portfolio. Number 5, revisit your plan. And number 6, speak to an advisor. And just to drill down on that a little bit more, the reason for an advisor is they're there to help you. Behavioral coaching is a huge part of, our role as advisors. So, please reach out. We're more than happy to help when it comes to that. So yeah, that's basically our 4 rules. But I wanted to basically go into a little bit further and just let you guys know exactly how Sarwa applies the 4 rules of investing that we've talked about, the 4 best practices, to our sort of investment solution. So with rule number 1, and starting now, you can actually open the account completely online. There's no need to go somewhere in person and sign 50 documents. You just download the app and you're good to go. You can also just start with as little as $5. So like, even if you don't have significant savings yet, at least you can start. Rule number 2, and diversify. So we actually create personalized portfolios of ETFs for you based on your risk and objectives. And these portfolios give you exposure to every major asset class, geography, and sector, and actually employ a very high level of diversification. When we're looking at rule number 3 and lowering your costs, our fees actually operate on a sliding scale of 0.5% to 0.85% per annum, depending on how much you have invested. This is absolutely the only fee that you're going to pay to Sarwa. We don't have any commissions or exit fees or trading fees or brokerage fees. It's simple as that. And last but not least, our favorite rule number 4, and managing your expectations. So the way that we're able to help with this is we actually have automated investments that take the emotions out of investing. And this includes investment rebalancing. So you as a client, you don't need to do anything. You just deposit money into the account. And that's really the definition of autopilot investing. We take care of the rest. And most importantly, we have an amazing team of customer excellence associates. We have an amazing advisory team, and we'd love to speak with you. So, it's my favorite part of the job is speaking with clients. So if you ever have questions or concerns, please don't hesitate to reach out. We don't bite. We're more than happy to help. And with that being said, I think we've been speaking for about 50 minutes. So I'd love to answer some questions.
Yes.
So yeah, why don't we do that?
Let's maybe just check. So if you have any questions, ladies and gentlemen, please do type them into the Q&A section of your Zoom platform, and then we'll be more than happy to take it up. I'll start on the chat one just in case, or the chat window, actually, just to see if there's any questions in
Sounds
here.
good.
I've got a salutation, a greeting and salutation from a Harry. I wonder if it's the same Harry that I know from our social media, our Insta Live. If it is you, great to see you again as well.
Yeah, and if it's not, welcome.
Petya said, I'm unable to hear you. I hope you were able to hear us, Petya. We've been speaking for an hour, and I really hope that you were able to. Okay, let's see. No, there's a question here from Abdullah. Says, do you do index funds?
Perfect. Yeah, I can be more than happy to answer that question. So Abdullah, so what we do is we do exchange traded funds, which is actually a form of an index fund. So an index fund will ultimately track, a major index, and the ETFs that we're invested in, they actually track a multitude of different indexes. So yes, actually, the ETFs are they're actually a form of index funds. And I know you mentioned also in the Q&A, if we do them, and one of the big reasons why we do them is because number one, they're extremely low cost. Number two, they provide a very high level of diversification. Number three, they have an extremely high level of capitalization. So, we have the two major, the biggest asset managers in the world, BlackRock and Vanguard, which are behind our ETF and index funds. And last but not least, they provide a very high level of liquidity. So if you as an investor need your money at any point, you never have to worry about, they're not worrying about anyone, not being able to access that money. So yeah, we do actually.
Spectacular. Thank you for that, Akshay. There's a question here from Diana, who asked, what do you mean by advisory fees? What do these include? Happy to take this forward if you'd like, Akshay.
Yeah.
So in our Sarwa Invest service here, Diana, basically we're going to provide you a recommendation of the ideal set of ETFs that you should be investing in. And we're going to take it further by managing this portfolio for you, by rebalancing your portfolio on an ongoing basis. We will also make sure to reinvest your dividends for you on an ongoing basis as well, to make sure it's in line with your risk profile, which is in line with your goals. In addition to that, any deposits that you make, if you're investing in dirhams, we will take care of the international transfer fee for you on your behalf to make sure it arrives at your brokerage account. Typically, if you were to do this yourself with any brokers, you'd have to send the money yourself, which means that you're going to incur an international fee. We absorb that. All of this service we provide with a flat fee, which is based on it's called Sarwa management fees. So as actually mentioned earlier, it starts off at 0.85% per year. This is on your total assets under management. If your portfolio grows to above $50,000, the fee will reduce to 0.70% per annum. And if your portfolio is above $100,000, the fee becomes 0.50%. So it's a sliding scale. So as your portfolio value grows, the fee actually reduces. Now, if you so happen to be in our starter account, which is basically any individual who has less than 2,500 US dollars, there's actually no fee for that account. And you have no fee basically for a year, because it's an opportunity for you to try us out, see how the portfolio works, to see if it's in line with your expectations, basically try out the service altogether. So just in summary, minimum $5 up to $2,500. It's considered a starter account. It's free for a year. Above $2,500 and up to $50,000 is 0.85% per year. Above $50,000 is 0.7, and above 100,000 it's 0.5. Hopefully that answers your question, Dana.
Perfect. Thanks for that, Eamon. Got a message over here. Let's take a look. So, question from Christina. My question is about short-term volatility. How long would you say that is? After 9 months of investing, I'm in the minus 10% roughly. Thank you for that. Perfect.
Absolutely.
So yeah, go ahead, Eamon.
No, I was going to say that it's been, I don't even want to say it's only this year, but actually we saw volatility happening since September of 2021. And actually leading up to September, it's been a pretty rosy picture. And when you look at it on a high level, 2021 overall was a very decent year when it came to market performance. But if you look at it from September until today, we've just seen a steady, downward trajectory when it came to the portfolios. And there's a number of reasons why. And we just did a write-up on this and sent it out to all Sarwa account holders today. We're basically just giving you a snapshot about what's been happening in the market. But in a nutshell, there's been a lot of concerns about inflation. There's been a lot of concerns about interest rate rises. Of course, this war between Russia and Ukraine is, adding further pressures. And the reality is that, it's unpredictable as far as how long this volatility would last. Historically, and I can say this because we have the data and we can see it in the charts, is that periods of volatility have always been significantly shorter than periods of prosperity. Take, for example, the 2008 financial crisis. The time period between the market turning from a bear market to a bull market was relatively small in comparison to the bull market. So whereas I'm trying to remember the exact number of months in itself, but I want to estimate and say maybe about 5-6 months, give or take in there. But the bear market was basically significantly shorter than the time period in which the markets were steadily growing. Post 2008 till about 2020, we just had steady, robust growth in the stock market. We had little hiccups here and there, but nonetheless, if you look at the S&P 500 between 2008 and 2020, the S&P 500 grew by 400%. So, we have a really great blog that actually talks about this in specifics, where it looks at the timeline of how long historically these periods of volatility have lasted. So it'll give you insight, and it goes all the way back for the last 50 years, I believe, so in the article. It'll highlight to you very clearly how it's performed in the past, but the near future, so we don't know at this point in time. We don't know.
Yeah, perfect. Thanks for that, Eamon. So got another question here from Lorena. Lorena is asking, hi, how do you charge your fees on capital investment or on the capital gains? So thanks for the question, Lorena. Look, in terms of the fees, we actually charge on the overall portfolio value. So depending on the amount of the value, that's what the fees are actually going to be charged on. That's actually the most fair way to do it, for you as an investor. Also, we're not doing it. It's actually calculated on a daily basis. So depending on the portfolio value on a daily basis, but it's actually charged per annum, but deducted from the account directly at the end of every month. And Lorena, I can see that you also, actually, no, sorry, not Lorena. Got a question from Hari. Hari's asking, how's the Fed rate hike impacting the market? How will the market react to it? And what do you feel is the outlook for the market in the next months, and whether inflation can be curbed?
That's a mouthful there, Harry. I mean, we can do a whole 1-hour session on that topic in itself. Yeah. But I mean, I'll take a stab at making it as summarized as much as possible. The Fed is in a very precarious situation right now because cost of living is rising, but it's not, unfortunately, just directly attributed to the economy in the US. There's external variables, which is the war in Ukraine, which is causing oil prices to go through the roof, which is causing food prices to go through the roof. And unfortunately, the concern is right now with regards to the Fed is that even if they do raise interest rates, is that going to be enough to slow down inflation? Especially considering that raising interest rates in the US will have no impact whatsoever on the price of oil that's considerably high, or the price of wheat that's considerably high, considering the fact that these two, commodities are basically, 30% of which comes out from the region of Russia and Ukraine. That's the concern with itself, Harry. So is it going to work? We sure hope it does, that's for sure. But I think what's going to happen is that you're probably going to see, and this is just Eamon talking, I can't really say I guess I said I don't have a crystal ball, but we're going to probably, it feels like we're probably going to see other developments where there's going to be other tools that central banks around the world are going to try to utilize to try to keep inflation under control, because it's a global problem. It's not just a US problem, it's a global problem.
Yeah. So got another question here. So Christina said, thank you for your answer. Would you advise then to keep regularly investing? Thank you very much. Christina, yes, look, that would be the best thing to do actually at this point in time. And honestly, in general, at any point in time, by actually depositing, a fixed amount of money on a monthly basis, it's the best way to actually basically employ something called dollar cost averaging. It's a really good way to take advantage of discounted prices and basically take advantage of fluctuating prices. We've seen time and time again that, if you regularly invest a fixed amount of money over an extended period of time, number one, it takes the emotion out of investing. You will have, no matter what is happening in the markets, you can focus on, hey, no matter what, I'm going to be investing this amount on a monthly basis, regardless of what's happening in the markets. So on a way to kind of going back to rule number 4, with managing your expectations and your emotions, that's a really good way to do it. But also, it also really, reinforces a positive way to reduce your average price per share. So ultimately, you're going to reap a better reward in the future.
I apologize because I know it's 7 o'clock and we're happy to continue. And for those who are not able to continue, I completely understand. This session is recorded and it will be sent to you. So any questions that you may miss, you'll be able to watch the video and be able to recap as well. But actually, if you're all right, we can stay on for a little bit longer to answer the remaining questions.
Yes, of course.
Amazing. I see a question here from, I just lost it, give me a second. I would like to, Mohammed Tabriz said, I would like to connect my invest account. I'm already a Sarwa account holder. Forgive me, Mohammed, I didn't quite understand your question. Do you mind if you can restate it for us so I can understand? Some highlights, Mohammed Tabriz said, okay, some highlights on Sarwa's past performance for its investors. So you can actually see that right on our website. So if you just go to our homepage, you'll be able to go to the tab, it'll highlight our entire menu of funds. It'll show you the historical returns. And you'll be able to see everything from low risk to high risk portfolio and what the historical returns have been.
Perfect.
Just trying to see here.
Let's see. I think we've got some more.
Charge your fees. I think you answered that one already.
Yeah.
Harry's question here.
I think I found one over here actually. A very simple one, which will take a second. Bilal's asked, are there any fees on stock trading? So simply put, no, Bilal. Our Sarwa trade platform is completely commission free. So you're actually able to buy stocks free of charge. So not a problem at all. So
there was a comment here. It wasn't necessarily a question. I think it was in relation to, I think it was Christina who had indicated that she's 10% in the negative. And it was a comment by an individual Sakib, who said, if Christina has to turn a positive in her investment, it means the market has to perform at least 20% for one whole year. Is that practical, right? Now, if we look at 2020, let's go back to, is it practical? Has it happened? Yes.
Yes.
Is it realistic? No.
No.
And it's being very frank about this, Akif, so it's a fair point. But look, on average, most of these portfolios will typically range anywhere between the 7 to 9% mark. Our portfolios, for example, our most aggressive portfolios have been averaging around 11.3% return, average. There's some time periods that are negative and some time periods that are positive. But I look at 2020, where we have clients who came in at the right time and they were up, 46%. We also have clients who started an investment journey early in January. The portfolios had dropped by 35%, but by the end of the year, they were net 20% positive because the market had rebounded by about 55%. So in 2021, the S&P, 17.6%? I'm trying to remember off the top of my head. So yes, it is possible to get double-digit returns. Is it a consistent thing? Absolutely not, Sakib. But keep in mind, what is Christina's investment horizon? It's not just a year. Her investment horizon might be 5 years, 10 years, 20 years. And don't forget, you receive dividends during that time period as well. That's free income that is being reinvested right back into your portfolio. And her money is making money. So practical in a year? No. But over the long term? Absolutely. She'll do very well at the end of the day.
Perfect. So we've got another question here so it's actually asking, it's easy to look at the global markets for over 100 years and see growth. However, does that rate apply over 5, 10, 15 years? Consider the objective is to achieve your goals and see returns during our lifetime rather than 100 years. Great question. And 100%, like obviously we understand that not everyone is investing, for a period of 100 years. But with that being said, look, Eamon used the example before, from the period of 2009 until up to now, the actual S&P 500 has returned around, 400%. And that's very realistic. That's in around, 10, that's between your 10 to 15 years. So, let's say even if it's half of that, which we expect it to be even more, that's an amazing, place to be in. And that's not, a period of 100 years.
Mm-hmm. I mean, look, if anything, if you have some downtime, just for fun, go to Google, type in S&P 500 and just play around with the chart. Look at the 1 year, look at the 5 year, look at the 10 year, look at the max, and look at any time period, right? And they would, let's just say for this example, use 10-year time period. So you want to do a comparison between time period 1 and time period 10, and you'll see the growth, right? Now, this is, the idea is that, you're not going to, using an example of 100 years is really more illustrative, just to show you what $1,000 would have grown to over a period of time, of course, right? And just to kind of highlight all the political events that have happened. But the whole idea of investing, it is meant to be long-term, and long-term should be ideally 10 years plus. Now, if you have an investment horizon which is shorter than that, it doesn't mean investment solutions aren't available. It just means that you need to practice a little bit more of a conservative approach. And there's various degrees of conservatism that you can apply when it comes to investing. For example, an individual who might have a short timeline of, let's just say, 3 to 5 years, they may value capital preservation greater than potential growth in their portfolio because they need this money in that time period. So they may actually take a more conservative approach. So instead of having a portfolio which is predominantly equities, we may have something maybe split down the middle, something more safer, fixed income, and the other half may be equities. Or maybe they might take a bigger portion of fixed income and a smaller portion of equities. There's different solutions to every goal that you may have. It's not a cookie cutter approach.
Definitely. Just got a question over here from Farhan. It's asking, is there any connection between inflation and gold? And will the price of gold go up with inflation? Okay. So Farhan, look, that's a really good question. And, commodities such as gold and other different precious metals, they're actually used, traditionally in investment portfolios as something called an inflation hedge. So the reason for that is, when inflation rises, a lot of people go to gold. And that's normally been the connection in the past. In terms of the price of gold going up with inflation and sort of way to predict that, we wouldn't be able to give you a sort of accurate estimate of that. We know why people go into gold and other precious metals in these times. A lot of times people go into real estate during inflation as well. Because if you think about it like this, right now, if we're talking about what Eamon was saying, look, the price of that house is, if it's $650,000, in X amount of years, it's a lot more. So if you're a real estate investor, you're going to be, appreciating with that. Mm-hmm. So that's why, as part of the Sarwa portfolios, we incorporate real estate investment trusts. As part of the halal portfolios, we incorporate gold as well. Because the whole point is you want a globally diversified portfolio that's going to counteract inflation. And that's the reason why they're in the portfolio, actually as an inflation hedge.
Mm-hmm. No, and I love that, the fact that you've highlighted the fact that there's no direct relation, and this is really key. People assume that if inflation goes up, interest rates go up, it's a direct, equivalent or proportional impact to gold. No, those two are not interconnected. It's just human behavior that causes us to value gold as a inflation hedge, but it's not directly proportional. I mean, just think of it this way. Since the dawn of time, the idea that if anything should happen, if the world is coming to an end, gold is your last savior. But who said that? Why is that? Are we literally going to go back to trading gold bars again? I mean, let's look at the logistics of melting gold if we are in that doomsday scenario to be able to do it. I think it's really more of a sentiment or really more of a human belief more than anything else, because there's no direct correlation between the two. But you tend to see sometimes where people fear, what's going to happen, and they buy more gold, which drives the price up. But I was just really quickly, while you were talking, just looking at the gold, just to see how curious how it's been reacting for the last little bit. If I look at November 2021, and then versus looking at June 2021, and considering the fact that we've had 2 interest rate rises so far this year, plus 75 basis points, we're basically back at the same level. And inflation has been, on fire for the last few sessions, reported by the Fed. It's you don't really see a direct correlation.
Yeah, and I think 100%. I think it's also something important to note is that, one of the traditionally precious metals such as gold, they're actually meant to have a negative correlation with traditional asset classes such as equities and fixed income. But look, as what Eamon said right now, we're not seeing that actually be the case because there's, as I said, like previously before, there are so many different factors that are impacting markets that it's very difficult to pinpoint, certain things. These are principles that we have in investing, but for them to actually, pan out that way every single time is unfortunately not the way that the world is, because then you would be able to predict absolutely every single outcome.
Maybe we'll take a couple more questions, Akshay, and we'll call it a day. Let everybody go enjoy their dinner since they're probably waiting to eat. There's a question by Sakib. I think it's the second. First one was a comment. Second was a question about how much do we lose on the exchange. So when you fund in dirhams here in the UAE, we will conduct the international transfer for you, as I said, with no cost to you at all. It's actually comped by us. The exchange fee that we utilize is going to be 3.6797. So converting dirhams to dollars is 3.6797. I hope sometimes I get dyslexic with the two, but I'm fairly correct.
Yeah,
the last two digits, right? So
that's good. Yeah, 3.6797. That's the one.
Thank you very much. Yeah. So it's almost like a rhyme. It just comes off.
Yeah.
797. Okay. So hopefully that answers the question.
Like a password you're gonna remember.
Exactly. There's this one comment I want to address because I saw it in the chat and I'm seeing it now also in the Q&A about fees that you incur. And I'm assuming it says international transfers. I assume it's because this individual is a non-resident. And so for those of you who are non-residents, meaning people who don't live in the UAE, I completely understand, if you're residing in KSA, Kuwait, Qatar, or, any number of different countries that we service, your bank unfortunately does charge you an international transfer fee because it is an international transfer. Now, we don't have any plans at the moment to basically reimburse you for those fees, but there are some product developments that we are looking into, such as the ability to make payments by card or other payment mediums to allow you to fund your account. Alternatively, and I apologize, I didn't get your name. I think you posted it as anonymous. The alternative scenario is we could always set up a trade schedule for you. And what that simply means is that, let's just say you'd have budgeted a set amount for the year, but you were sending it on a monthly basis because you want a dollar cost average. Well, we can do that for you here. So for example, just utilize an example. You have $50,000 that you want to invest over a period of a year. You can send the $50,000. We'll send it directly to your brokerage account, but we'll organize it or coordinate it so that a set amount is invested every single month from the $50,000 on your behalf. So you'll see a portfolio, it'll have $50,000 sitting in cash, and whatever portion you've allocated, you decided to allocate every month, will be basically invested for you. So that's one way we can help you with your fees so that you don't incur any fees there.
Perfect.
One more. Let's take one more.
Yeah.
Isra just came in with the question, so let's answer this one. What happens if I end up leaving the UAE? Will my account get frozen? Isra, I'm happy to share with you that wherever you go, you can take your Sarwa platform with you. This is an international platform. Your residency is not a requirement to open a Sarwa account. In fact, we open accounts for non-residents every single day. We provide our services to any country around the world, with the exception of sanctioned countries, of course. Other than that, of course, you're more than welcome to travel and enjoy.
Yep. And then one extra layer over there as well, Isra. Look, in terms of you leaving a country to live somewhere else other than the UAE, we're actually a regulated entity. We're regulated by the DFSA, which operates out of DIFC. So the DIFC, as well as the Abu Dhabi Global Markets, they're offshore economic free zones. So we're actually licensed to provide you with advice globally. So it's no problem at all. You can still fund that account anywhere you want to. So yeah.
Amazing. Thank you for joining us today. We do hope you've enjoyed it, and we hope you got something out of it. Do reach out to us if you have any questions or anything that you'd like to discuss. But otherwise, we hope to see you and join us as a Sarwa account holder, and any support that you need with your long-term goals, we're here to help.
Perfect. Yeah, look, Eamon, thank you so much. It's a pleasure doing this with you and everyone who joined in today. Really appreciate you staying, 15 minutes later than required as well. And look, as Eamon said, if you have questions, concerns, want to have a chat, please don't hesitate to reach out. We are more than happy to help. Have a great evening, everyone.
Great evening, everyone. Take care.